Imagine this. You go into a store in Italy to get a Coke, and to your surprise, when you get to the checkout, you don't pay in euro. Instead, you pay in US dollars. That doesn't seem right, does it? Well, this is a possibility across the European Union if it does not respond to the rise of stablecoins. Stablecoins, which are digital tokens that are pegged on a fixed one-to-one basis to a currency like the US dollar, are an existential threat to the EU. Today, we will examine why, how the EU is responding, and how we got here. The EU fears the rise of stablecoins because it makes it harder for the euro to compete with the US dollar. The euro is the second most used currency in the world and accounts for just under 20% of global foreign exchange reserves. The US dollar is the most dominant and popular currency and accounts for about 58%. The EU is actively trying to reduce the dominance of the US dollar and increase the euro's global status. The increasing popularity of stablecoins threatens to prevent the EU from doing this. President Trump signed into law the Genius Act, which has paved the way for stablecoins to enter the mainstream by providing a federal framework for regulating stablecoins. It is now estimated that the stablecoin supply will grow to $2 trillion by the end of 2028. US dollar-pegged stablecoins will likely dominate this huge market. This would foil the EU's attempts to reduce dollar dominance for two reasons. First, US dollar-pegged stablecoins would become accessible across the world and may be adopted en masse by developing countries with unstable currencies, which would dollarize their economies, so they would effectively adopt the US dollar as their currency. This gives the US the ability to grow their global influence through the US dollar and take this opportunity away from Europe. Second, an explosion in the size of the stablecoin supply would drive up demand for US treasuries, allowing the US to finance its debt at a lower cost. Because stablecoin issuers hold US treasuries as reserve assets, so that stablecoin tokens are backed on a one-to-one basis by a US dollar denominated asset like US treasuries. Lower financing costs for the US means higher relative financing costs for Europe, which reinforces US dollar dominance. But an even more important reason why the EU fears stablecoins is because they threaten the EU's monetary sovereignty. The European Central Bank, which is the EU's equivalent to the Federal Reserve, fears stablecoins because they threaten the bank's ability to control and implement monetary policy. The ECB's role is to control the issue of the euro as a currency and maintain price stability. Europe is increasingly reliant on digital payments. Many Europeans do not use cash. And in Europe, there is no single European payment solution that allows online, peer-to-peer, and business-to-business transactions throughout Europe. Cross-border payments between EU member states that use the euro and EU member states that don't use the euro are expensive, inefficient, and can take days to settle. International card schemes dominate retail card payments in Europe, with companies like Visa and MasterCard accounting for 61% of all transactions. Even the national card schemes are co-badged with international providers to enable cross-border transactions. Stablecoins offer Europe an efficient and cheap cross-border payment solution and a way to reduce reliance on international card schemes like Visa and MasterCard. Unfortunately, the issue for the ECB is that 99% of stablecoins are denominated in US dollars. One Tether USDT token, which is the largest and most widely used stablecoin, is equal to $1. The ECB and wider EU fears something called digital dollarization, which involves the replacement of a domestic currency with a digital foreign currency. If Europeans adopt US dollar-pegged stablecoins in significant numbers and use them for transactions, then payments will be directly linked to the dollar rather than the euro. For example, instead of Europeans thinking of a Coke costing €1, they would think of it as costing $1 because they would think of it in terms of stablecoins, and one stablecoin is equal to $1. In this example, the euro would no longer be the dominant currency for expressing prices. The EU's monetary sovereignty would be completely undermined because they no longer control the unit of account. Philip Lane, member of the executive board of the ECB, has gone as far as saying that an erosion of monetary sovereignty like this would have historical and symbolic meaning because the euro is seen as a symbol of European identity. Europe's reliance on international payment providers adds another level of vulnerability because these payment providers could launch their own stablecoins. For example, PayPal has launched its PYUSD stablecoin and plans to offer it as a payment option to more than 20 million small and medium-sized businesses. It will allow businesses to make instant payments without using traditional banking networks or intermediaries, and businesses can also accept payments in PYUSD stablecoin from customers using card terminals. This is an issue for Europe because international payment providers are deeply embedded into the European payment system and can roll out US dollar stablecoins to the European market in a way that is accessible and useful at a moment's notice. But what's even worse is that stablecoins could completely derail financing in Europe. In Europe, about 80% of corporate financing comes from bank loans. The banks fund these loans using customer deposits. If these customer deposits are kept with stablecoin issuers rather than with European banks, then European banks will struggle to provide loans. Imagine if all the banks in Europe had €100 in deposits to lend out to businesses. But then one day, businesses and individuals adopt stablecoins in significant numbers, and now half of these deposits are kept with stablecoin issuers outside of Europe. In this simplified example, the ability of European banks to finance Europe's businesses is greatly reduced. To fill the gap made by this deposit flight, European banks would have to resort to using more expensive wholesale funding, which raises the cost of credit in Europe. US corporate financing is not threatened by stablecoins because US corporate financing is not reliant on bank loans. Instead, the US has a market-based financing model, and so corporate financing comes primarily from sources such as raising money through stock exchanges and issuing corporate bonds, which allow US companies to borrow directly from investors. How is the EU responding to the stablecoin threat? The EU's response is the digital euro. This would be a digital form of cash issued by the European Central Bank, which would be accepted everywhere in the EU. A European would set up a digital euro wallet through their bank, or if they don't have a bank account, their local post office, and would put money into the wallet by moving money from their bank account into the wallet, or by depositing cash in the post office or bank. And this cash would then be credited to their digital euro wallet. The digital euro has fundamental issues, and one of these issues is that it could be used for money laundering. A much touted feature is the ability to make offline person-to-person payments, where only the person paying and the person receiving the payment would be able to see each other's personal details. The level of privacy would be similar to an in-person cash payment between two people. This feature allows bank deposits to be withdrawn and privately transferred to another digital euro wallet as payment for an illegal activity. This payment could then be moved internationally through these private peer-to-peer offline transactions. The digital euro would make the most difficult part of the money laundering process, called the layering stage, much easier. This stage involves moving the money internationally through multiple transactions to distance the money from its source and make tracking the origin of the money more difficult. On top of that, the digital euro wallet would be available to people not resident in the EU, without a fixed address, and without a bank account, making it even more exploitable. The EU has long criticised stablecoins for being used in connection with crime, but their digital euro solution has not addressed this issue, and might even be worse. The EU has realised that the digital euro might be used for money laundering, and responded by imposing transaction and holding limits per wallet for offline payments. But a basic money laundering technique called smurfing, where criminals split large payments into many small payments, easily circumvents the transaction limits on offline payments. For example, a criminal organisation wants to move €10,000 in cash, and to get around the digital euro wallet transaction and holding limits, they get a large amount of money mules to each take a small amount of this €10,000 in cash, and then deposit this cash into their digital euro wallet in their bank or local post office. This €10,000 can now be quickly and privately transferred internationally, and at the same time, physical cash has been converted to digital deposits, which is a goal of the money laundering process. The digital euro also cannot compete with stablecoins because of a key reason: holding limits. There will be a holding limit of €3,000 per digital euro wallet. Stablecoins do not have holding limits, and so it is unclear why Europeans would use the digital euro over stablecoins. One of the stated reasons for the existence of the digital euro is to compete with stablecoins, but the EU is willingly putting limits on the digital euro, making it inherently less useful than stablecoins. What is the reason for these holding limits? Remember the deposits issue faced by European banks we discussed before, where we said that European banks are dependent on customer deposits to provide loans? That's why. If there is a mass movement of bank deposits into digital euro wallets, this deposit flight would make it difficult for European banks to provide loans. For years, the EU has been dismissive of cryptocurrencies like stablecoins and has refused to acknowledge the opportunities that they offer. ECB President Christine Lagarde has been especially critical of cryptocurrency generally.
There are cryptos
and euro crypto.
for which I'd say forget it, unless you're prepared to lose it all. How many of you have invested in cryptos?
No one.
Good. I'm pleased for that, because at least you have not taken stupid risks. In life, you have to take risks, but they shouldn't be too stupid. This one is, in my humble view, a dangerously irrational one. Cryptos are no currencies. Cryptos often referred to as assets are more liabilities than assets. And I have my doubt as to whether or not we should actually regulate them.
These statements demonstrate a stubborn and dogmatic view of cryptocurrency that simply refuses to recognize it as a legitimate asset class, even when faced with growing adoption and acceptance of cryptocurrency by European citizens. During the Industrial Revolution, Europe was a major driver of innovation, but this has now given way to the EU's constant reluctance to face facts, which leaves the EU always having to react to change, often when it is too late, rather than anticipating change. However, there are signs that the EU has realized that it is falling behind. In response to the Genius Act, the EU is now considering running the digital euro on the Ethereum or Solana blockchain to speed up its implementation. So, do you think that stablecoins are a serious threat to the EU? And could the EU actually become dollarized? Let me know in the comments. Thanks for watching, and I'll see you in the next video.